Hi, this is Yeho. I'm a option trader. It's Wednesday, October 15, 2025, 8:19 a.m. German time. Today, I'd like to go over yesterday's market review and also touch on the IMF's Global Financial Stability Report, which was released last night, the October edition. Okay, first, market review. The Nikkei closed at 46847, down about 1200 points or minus 2.58% down from the previous day. There was a brief moment when it almost reclaimed 48000 level, but the session ended in the 4600 range. So not quite a Black Tuesday. The volatility index stayed high at 32.81, still tense. PL came in at 18.11, and EPS held firm at 2583 yen, which means earnings momentum remains solid. Power, FX and bonds and the electricity price and JPX spot rose to 13.52, up from around 11 yen recently, and a sharp rebound from mid-October. So energy costs are creeping up again. The yen remains steady at 151 per dollar, and Japan's 30-year JGB yield is holding near 3.2%. Overall, stocks corrected, but not in panic. Futures are hovering around 4700 now. Still, the high volatility and rising power price feel a bit unsettling. Okay, next, US and global markets. The S&P closed at 6644 points, down 0.16%, basically flat. The VIX stays elevated at 20.8, and the moving index sits around 80.5. 79 point. Gold remains strong, trading near 4142 dollar after Black Friday testing the 4000 line. Its volatility index GBZ stands at 26.1, which is quite high. So, overall, after last Friday's sharp move, markets calmed somewhat, but volatility across the set is still flashing yellow. Okay, political and global events. The World Economic Forum continues this week, and the G20 Financial Minister meeting kicked off on 16 and 17. Domestically, Japan's opposition parties, Constitutional Democratic GPP and Ishin, are holding a three-party meeting today. Meanwhile, next Prime Minister candidate Takaichi is meeting individually with the other party leaders. All this will generate plenty of headlines leading into the October 20th Prime Minister vote. So both political and geopolitical factors could fuel volatility this week. IMF Global Financial Stability Report October edition. I covered the April edition early this year, but this new one lies tone. The warnings feel louder now. Let's highlight a few key risks that IMF pointed. Okay, first, localized bubbles. Not as extreme as the dot-com era, but we are seeing a sharp concentration in certain segment, the Magnificent Seven and semiconductors, data center, infrastructure, and copper-linked stocks. These sectors are driving variation in operation. Second, the sovereign bank nexus. Government support and domestic bank exposure have become tightly linked, and that keeps funding stable in good times, but it also means shock can amplify fast within the national balance sheets. Third, non-bank financial institution. The MBFY as heavily tied to banks, so excessive risk taking in the shadow system can feed back into the core banking sectors. And for the US Treasury market, this to me is IMF loudest alarm. Their stress tests show false treasury sales could reach $300 billion, about 45 trillion yen, at a scale we are taking Lehman-style stress. If that happens, and core equity capital, the CET1 ratio could drop below the 7% and danger line for many banks. In the IMF scenario, the global banking system average CET1 falls from 1.8% to 2.1%, a sign of widespread capital pressure. As a vulnerabilities also mention stablecoin, cyber risk, and expansion of non-bank leverage, but clearly the centerpiece of this level is U.S. Treasury fragility, the core vulnerability of the current system. Okay, my take back in April is the IMF was already warning, but that was right before the Trump tariff shock. Markets ignored it. Then it rallied hard. Now, those same risks are back only at high valuations, and that market, the setup of fragile. Gold, strange, and the elevated GBZ might already be priced in those bond market concerns. So the tutorial to watch is clear: gold and the US Treasury yield and the MOVE index. And who report is available online, easy to read with the translation tools if you curious into West Greek. Let's keep an eye on the US bond market, and that's where the next shark could start. Okay, and as always, and think of my contents as wrong positions and wow. See you tomorrow.